minutes till the bell. Stocks in good shape. Bull market is raging. S&P's well through that 5,000. Let's bring in our Schwab team for a big picture discussion. Also, with a little look ahead to next week. Kathy Jones, Chief Fixed Income Strategist, and Kevin Gordon, Senior Investment Strategist. Great to see you guys on Friday. So we're blasting off, Kevin, our earnings to thank for this latest leg of the rally.
I think that's part of it. I mean, you've also got pretty solid momentum, especially when you move up the cap spectrum. But I would also argue in some areas like small caps today, even where breadth might be lacking in an index like the S&P 500. So I think that's part of it. But I think it's also, the fact that CPI revisions for, last year and specifically for the last 3 months of 2023, this morning, there was sort of no news there, which was good news because you had seen a continued trend of disinflation. So I think it's really the market maybe settling down a bit and looking ahead to probably what is going to be, a really packed week for economic data this upcoming week.
Bonds seem to be getting slightly more interesting, Kathy, but everything went well with the auctions, so certainly no panic in this market, right?
Yeah, I think we're consolidating after the Fed meeting and after the strong employment report. The market's just kind of digesting the fact that we're not going to get as many rate cuts as soon as the expectations suggested. And so we're readjusting, and that the economy has been quite resilient. So even though inflation keeps coming down, we still continue to see some resilience in the economy. So that's pushed up yields, especially in the belly of the curve in that, 3 to 5 to 7 year area. We start to see some lift there, but it's been kind of a gradual readjustment, not a big sudden move that like we've seen in the past.
We had a big, busy calendar for Fed speakers this week, but I feel like they were the most muted in terms of impact I can remember for a week that had 10 of them. What'd you make of the way the market interpreted their language, Kathy?
Yeah, I think they're finally accepting what Powell said is that, we're not going to cut rates right away, and not as much as the market was anticipating. And, that's sort of aligns with what our expectation had been. We'd always said that we thought mid-year for the start of rate cuts, maybe June meeting, and then it would be, a gradual sort of slow approach as long as the economy is doing well. And that's where we are right now. So we're going to stick with that expectation. And I think that's why, there really wasn't, we're just kind of slowly adapting to the fact that the Fed is doing what it says it was going to do.
Okay. How much of that is helping the equity market confidence, Kevin, that yields are consolidating and the Fed generally pretty clear about now what their plan is?
Yeah, I mean, I think the clarity, at least in terms of the trajectory of policy, now that we know that, the next move is probably a cut, and that it's probably not going to be, as Kathy was saying, as aggressive at points that the market was pricing in. So I think that's definitely helped. I think what has also been helpful, maybe more marginally for large caps relative to small caps, and, you and I have talked about this recently, Oliver, is this, the relationship between yields and stock prices and not being as aggressively negative for large caps relative to small caps. But at the same time, I think that if you get a little bit more compression and bond market volatility this year relative to last year, that is one of the factors we think can be supportive for the equity market this year. The thing that we're keeping an eye out for is whether you get a little bit of a trade or a switch in positioning where equity vol starts to take the baton from bond market vol, and basically a flip of last year. Doesn't necessarily mean that stocks have to do poorly in that environment. It just means that you're probably getting more of a choppier range, especially for cap-weighted indexes like the S&P 500, because you have larger swings that are attributed to, 5 or 6 stocks at times.
Okay. The strength of this market has been impressive on the earnings side. It's supported by the Fed, at least in this when, not if conversation. And that's where I kind of wonder, Kathy, if. I mean, we have numbers for inflation, the next 2 readings going into March. Let's say they start to surprise. Maybe we get like what we got in the ISM prices paid for services, where there's a big surprise. Is there any possibility that the conversation of when instead of if maybe goes back to like an if? Is there any scenario in which the Fed doesn't go on a multi-year cut path this year?
Well, there's always a scenario, right, Oliver? If we were to get a big upside surprise in inflation, certainly that would mean the Fed would have to reassess its plan for cutting rates. this year and possibly maybe even reverse course. I don't think that that's really likely, but that's always out there. That's always a possibility. But consider right now, real rates are pretty high. Inflation has been coming down. And so there's room for the Fed to just sit tight, even if inflation bubbles up a little bit. But clearly, it's always, a possibility. I'm just hoping that we do pass, as Kevin suggested. I think that would be a good outcome.
Okay. Thinking about the next step here, the Russell's been trying to punch a little higher. Kevin, what's the last piece then, I guess, of the bullish puzzle to get those companies back at highs? Do you see that in the cards anytime soon?
Yeah, I think it's a mix of, as I mentioned, with bond market volatility being a little bit more compressed, really just understanding that from the Fed's perspective, this really aggressive combating of inflation has just changed. I mean, the fact that they've been now more consistent in where the policy trajectory is looking out ahead, I think that's probably going to at some point filter down to small cap companies and help them understand what that overall path is. But at the same time, you do have small companies that are more susceptible to shifts in rates. So if we are in a higher for longer environment, particularly in the real rate, arena, I think that is probably more of the differentiator for who does well and who doesn't, because you've still got, anywhere from 30 to 40%, depending on what time horizon you're using, whether it's the past year or the past couple of years, anywhere from 30 to 40% of the Russell 2000 that just doesn't have any earnings, and a similar percentage that are zombie companies that don't earn enough to pay what they owe on interest expense. So I think that's going to have to be a key factor that you look for, and why we've really just emphasized for anyone in the market, in the equity market, whether you're in large caps, whether you're in SMID caps or small caps exclusively, just to have that quality lens and quality filter, because it's really going to matter regardless of what happens in the next year or the next 2 years. If you go into a recession, it's definitely going to matter. If you stay in a higher for longer environment, it'll matter because you can have a little bit more of an active bias in picking companies that work in that environment.
All right, makes sense. Great conversation, guys. Thank you very much for your time. Kathy Jones, Kevin Gordon, have a great weekend, team.